Thank you for joining us on Commands of Commercial Real Estate. This is your host, Kamil Razai. Today we have Mr. Kashy back on the show.
Hello.
This will be kind of a special episode regarding one particular vehicle you have for business owners, and we want to go more in depth on it.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
This is quite a revolutionary product. It's a game changer in the industry. It's been around for quite a while, but not many people know about it. And a lot of my high net worth, high income earner, and especially my business owner clients are taking advantage of this product.
So how does this vehicle work?
It is primarily based on a permanent life insurance product that will grow your cash value tax deferred, give you a death benefit, and you have all the advantages that the IRS gives you in being able to pull the money out tax-free. The beautiful part of this program is you only pay 1/4 of the premium. The bank pays the other 3/4. And hang on, even better yet, traditional financed life insurance plans, as when we first met, I was doing those, require collateral, require you to have great FICO score, to get fully underwritten, and you tie up a piece of property in order to be able to collateralize against the loan. This policy has none of that. This program literally uses the insurance policy as the collateral. No credit check, no income requirements every year. You just have to show that you're able to pay for it. No collateral, nothing. The bank pays for 3/4 of the premium. You pay for 1/4 for the first 5 years. The bank takes care of the rest for a 15-year period total. And they walk away at the 15th year. You have the product, you have the life insurance policy, it accumulates tax deferred, you pull the money out tax-free, and you have life insurance on top of it. Plus a lot of other living benefits.
So why would one take this policy versus a traditional whole life or universal life or a variable universal life?
I'll start with variable because a lot of my clients use variable products in order to be able to have money for retirement. A variable product works with the stock market. You're actually tied into separate accounts, which are like mutual funds. As the value drops, so does your value of your cash value. When the market goes back up, you have to work your way up from where you were below the level threshold, shall we say, of how much you had before to be able to get some more gains. We experienced this in the meltdown in 2009, 2010. I had a lot of clients who had variable products. Some of them wound up having to give it up because they didn't have at the time the money to keep it going. Some of them had to wait several years to be able to be back to where they were and then work their way back up. This policy has guarantees in it. You get really good returns, zero risk. If the stock market goes down, you get zero return, you preserve all your cash. And that is why the banks love it.
Let's go through two examples. One would be a person that has, let's say, net worth of, let's say, 3 to 5 million, who's growing their real estate portfolio, might be younger, might be older, but they want some kind of, a policy in case something does happen to them to protect their families and also for future income when they retire.
I have several clients that have commercial real estate, whether it's multi-family housing or industrial type of buildings. The reason that they want to do this is, especially in California, you don't know what the future is going to bring. 20 years ago, we would not have expected all these laws to have been passed for people's estates being transferred with properties, homes, and the taxation, all the taxes that are due along the way. Nobody has a crystal ball. This way, I have clients that are taking the money because commercial property has a cash generating product. You continuously have income coming in, barring vacancies and what have you. What my clients do is they take a portion of what they have coming in. They put it in this product. It's outside of properties. It is protected from creditors. And they have a guaranteed pension. Along the way, they have a death benefit that's pretty high that satisfies their death benefit needs. It has a living benefit in which, in case they have long-term care, which have long considered the Titanic of everybody's retirement plan. As you know, I'm a product of that. And I had a father who needed long-term care, and the cost is insane. Our generation does not want to burden their kids with these expenses. This policy will give them up to $1.5 million to apply towards long-term care or critical illness care.
Is that from the cash value or separate of that?
It's part of the death benefit. You get to tap into that death benefit. It comes from somewhere, but it doesn't affect the cash value. You're taking an advance on the death benefit because of the situation. The beautiful part about this product is it protects you at every stage. As you have family, as you have needs, you have a death benefit that gets paid out. The one thing with this product is if the bank is still on with you and they're giving their money and they haven't pulled their money out yet, they get their money first. So I have a client who recently did a policy on, it's a $4.6 million policy. The bank will have loaned out a little over $1.7 million. At that point, once the bank's paid everything out and they're waiting for the cash value so they can pull the money out, they will take $1.7 million, $2.9 million goes to the family tax-free. Now, if something happens within the first 3 years of the policy, it's whatever the bank has put in thus far. It is not a total of what they would have put in. So you're protected no matter what. Now, let's say that you live a very long life and time comes to retire. You can pull money out tax-free. You've grown this money tax-deferred. The bank's giving you 3/4 of the money. They're gone and you're taking this money out tax-free. And you still have a death benefit. If you get sick and you need long-term care or some sort of critical illness, you have $1.5 million that you can tap into. Now, my business owner clients love it because you and I are business owners. We tend to do everything for our clients and wind up neglecting ourselves. We put off planning for ourselves because we're so busy taking care of our clients and our obligations. This takes care of that for you on multi-level. I have had clients that the only issue they've had with it is, why didn't they do it sooner? And I have clients that are literally like, can I do more? And they want to stack, especially the younger generation. They want to do their 5 years commitment, and then they already have planned to do the next 5 years. They want to make sure that they don't have to work. They want to make sure that when they build, the property owners, especially the commercial property owners, when they finally pass on, they don't want the issue of the IRS coming in and the family having to deal with all the stuff. And I'm dealing with one right now where my client is absolutely beside himself because it's a generational type of business. And the founder, being his father, is very old school and is not moving as fast as he should in order to do all the estate planning. And now he's like, I don't even know what I'm going to do. I'm going to spend probably a year just trying to figure all this stuff out if he passes on. This way, he's got all that stuff taken care of. Depending on how far along it is, he can do whatever he wants. He can leave this thing be, pull money out later. If he passes on, his family gets the cash tax-free from the insurance company because it's a death benefit. And he can deal with whatever he has to deal with without the headache.
Is that death benefit a part of his trust?
Well, there are two different types of policies. This one is if you have a living trust, yes, you put in your living trust. For estate planning, you need to put it into an irrevocable trust, because the IRS is going to come back and say, hey, death benefit is part of your estate, so therefore more estate taxes. When it's its own separate entity, it's outside of your estate, it pays the IRS, everybody's happy.
Let's go through an example with easy numbers. Let's say somebody, we won't talk about the age because every age obviously determines a different premium, is getting a $5 million policy based on this new product, and yearly is $50,000.
Depending on their age, obviously. I have one currently that we just did who did close to 50, a little bit over 50,000, and they are 34 years old. The contribution of $50,000 is their commitment every year, annually for 5 years. They put in $50,000, the bank puts in $50,000. They're doing it for 5 years. So our client is in for $250,000 total. The bank is putting $250,000. The second 5 years, the bank is putting everything in. Now the bank puts in, by the end of the 10th year, $750,000. The client's only put in $250,000. The bank waits 5 more years. They will withdraw from the cash value the amount they put in, which is the $750,000 plus the interest that they are charging, just like any other loan. They walk away. My client sits on that policy as if it does not exist. Doesn't tap into cash value, doesn't make any more contributions, doesn't do anything. When he's pulling his money out at age 65, he's pulling out $264,000 a year for 25 years.
Tax-free.
Tax-free. For the first year, every dollar that he put in is already come back to him. Everything else is gravy. In the meantime, there's death benefit. So that leverages the dollar even more. And there's, in the event that at age 75 something happens and they need critical illness, they have that. And if they live a long, healthy life, they'll have $264,000 a year. Over the life of the distributions, they're at $7.6 million tax-free that they've pulled out. Then they still have a death benefit of over $3 million. Now, critics will say, what's $3 million worth in 50 years, 60 years? Who cares? You put in $250,000. Your first year, you got more money back than you put in. You've had death benefit this whole time. And you've taken $7.6 million in your pocket. If you want more money, do another one 5 years later.
What happened between the years 11 through 15?
Nothing. It's just cash value accumulation.
No contributions from the bank at that point either.
The bank just sits on it and they charge their interest rate on the money that they've loaned. Just like anywhere else, banks charge interest rate. So they're just sitting there waiting for it to come out. The beautiful part for the banks is it is considered an asset. There's no downside risk to this. So on their books, this is an asset. And the banks over the years, there's over $7 billion that they've loaned out. And we're not talking about Shifting Sands of Arizona Bank. We're talking major banks that are part of this. And they get into these tranches and they give the money out and they're perfectly happy doing it because they make a lot of money back.
What are the rates roughly on those?
It's the SOFR rate plus, it varies, but it's usually plus about 2%.
Is there a minimum amount and a maximum amount?
It varies. I have clients that are put as little as $30,000 a year in. Depending on your age, what we do is we work out your budget and what your needs are. So if you have a client who is in their 40s, they're going to need to go a little bit higher. They can't do like a $20,000 a year contribution. It won't really work that well for them. It still will work well, but it just won't be something that they can rely on to live off of when they retire. A younger person, they can do 20,000. They can do 100,000. It's all in their budget. And I sit down and I go through it with them, and we do illustrations and we discuss things and make sure that it's something they're comfortable with and something that works for them. if something happens, this is a question that comes up all the time. What if something happens and I cannot contribute anymore? After 2 years of making contributions, I can't hold up my end of the bargain. You're not holding up your end of the bargain. We're no longer putting money into the policy. They will take what they're into the policy for only out of the cash value and walk away
Plus the interest or no?
plus interest. But if it's 3 years, there isn't that a whole lot of interest that that's accumulated. They'll take their portion, walk away, give you the policy. It's up to you what you want to do. If you want to cancel the policy, you can. If you want to just make less payments, it's on you. It's your permanent policy to do as you wish.
Is there a minimum age?
Yes, you have to be 18 years old and you have to have income. You have to have, show that you have assets or you have about a little over $130,000 a year income.
What if your parents want to contribute for you?
They can. There's actually a legacy generational wealth building option where the parents will do it. But you have to be 18 years old.
I mean, it's a very unique, policy instrument for, people that own real estate and a lot of businesses. I mean, what would be your number one, key information you would like people to know about this?
Well, I have never had a client that did not like it. If you have the means, try and see if it fits your plans for the future. You're leveraging your money. And that is huge. Even Forbes, they all say, if you can leverage your money, do it. You're using the bank to cover for 3/4 of the cost. They walk away. They give you the whole thing. You pull your money out. You're literally have your own pension, which is on, I like to call it as a Roth IRA that is on steroids, human growth hormone, and Viagra. I mean, this thing is absolutely amazing. It works very well for my younger clients, but I have clients that are in their 50s that are doing it, and the numbers will look great for them.
What if somebody goes through a bankruptcy during the first 5 years? And also another scenario, if they go through bankruptcies between years 6 and 15, what happens to this policy?
These policies are exempt from collectors. Cash value could be $3 million. They can't touch it. It is specifically written in a state which has that protection.
That's great.
Absolutely.
This is one of a few policies and or items that are exempt.
When I say it's your own personal pension, I mean it, because pensions are exempt from that. We all know that from the O.J. Simpson situation where the family couldn't touch any of his pension and he was living pretty off of that, and nobody could do anything about it because it is protected by the federal government. This is protected by the state in which it's written, so you can't touch it.
How can the viewers reach you?
People can reach me in the information that is below in the description, or they can just go ahead and email me at kashy@theartofinsurance.com.
Well, Kashy, thank you again for being on the show, and I hope the viewers get a lot of pertinent information about this new product.
Thank you very much for having me. It's like I said, it's an amazing product, and haven't met somebody who doesn't like it yet.
Great.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.